Hey everybody, welcome back. It's Milkshakes Markets Madness. My name is John Kutsmeda. This is Brent Johnson. And look, we talk markets. We talk the madness of markets. We talk Brent's Dollar Milkshake Theory. If you're not familiar with that, you can go to the Start Here playlist on the top of the YouTube channel and learn all about that. There's a lot to cover. This week, we went into a Super Bowl weekend with our previous episode. We're not going to have time to get into the actual NFL Super Bowl and our takes on that. But then shortly thereafter, Brent had the Super Bowl of dollar debates. We're going to get his take on that. And as you can tell, Brent did not get a new tapestry backdrop. That's more my style. He's on holiday in St. Bart's, celebrating his 20th anniversary. Brent, you've accomplished a lot in your life, but I have to say that's probably your biggest accomplishment.
Yeah, I think it's you can point at different things that you've done well, but that's probably the one I've done the best. So I'm happy to be here.
Awesome, awesome. So let's get your take on the debate. We had uploaded it to the channel. It's a long one. It's 3 hours long. We didn't really expect people to watch the entire thing, but we've had tons of comments. So there's definitely been some positive takeaways from what people were able to consume. What was your take?
Well, first of all, the first thing I'd say is I really had fun doing it. And as I said at the very beginning of the debate, I've learned a lot from records over the years, and I learned a lot from Bob Murphy over the years. But what it really comes down to, and I think the other guys would agree, is that there's just no other alternative right now. And I know there's a lot of things that people would like to be a suitable alternative, and I know there's a lot of people that are coming up with ways and trying to come up with ways and debating ways. But the reality is there's just right now there's just no other. There's no alternative to the dollar. And when really pressed, they kind of agreed with that, right? And so it was kind of funny because when we were kind of setting up the debate, one of the biggest questions was, are we going to say by 2030, by 2035, or by 2040? In other words, nobody thought it was going to happen right away. And the fact that, we settled on 2030, I think it's really unlikely there's anything suitable by 2030, maybe by 2040. But anyway, it was a fun thing to do. I'm glad we did it. I felt like our team won, obviously, and until somebody can come up with a suitable alternative, that's the only game in town.
Well, just to fill some people in, one of the things that you say a lot when we talk about the dollar milkshake theory is you felt like you were on the wrong track as soon as it was basically disagreeing with everything that you thought was reality. And it really helped give you a framework to look at the market as it is, not the way that you want it to be.
Yeah, that's exactly right. And it doesn't mean that I want things to be this way, but it's reality. And I think the biggest for anybody that's kind of going down this path for the first time, you have to understand the euro dollar market. I think in many ways both Jim and Bob, who were on the other side of the debate, don't fully understand the euro dollar market. And the thing is, I don't think anybody fully understands the euro dollar market. But those of us who have studied it quite a bit, I think, have a better handle on it than most. And that really is kind of the key to understand why the U.S. has been able to get away with everything they've been able to get away with, and yet the dollar is still, near its 30-year high, and hasn't been inflated away the way many people have predicted it to be.
Well, when we started this show, we agreed that it wasn't going to be the dollar milkshake show. I think that's kind of why we have, the madness. We thought there'd be more kind of the back and forth interactions you have on Twitter. And so what I think we'll do, because you are somewhat short on time, given you're celebrating something important this afternoon, what we'll do is I think we are ready for more of a revisit of the euro dollar market and the dollar milkshake theory. But there were some other things that were important this week that I think it's worth talking about. We were kind of saying it was a Super Bowl week, not only because of the football game and your debate, but because of a huge, as we joke, the most important CPI ever. But it felt like the Fed was prepping us the week prior that this was going to beat expectations or miss expectations, depending on how you want to look at it. Inflation was hotter than expectations.
Yeah, I have to say it was a really interesting week in that we had a couple of inflationary prints that beat expectations, and markets sold off initially on both of those, but kind of by the end of the day on each day, markets were kind of back to where they were. And this was pretty interesting to me. Is there was a couple comments from Fed, from some Fed speakers who I kind of expected when we had these hot inflation prints to say, see, this is kind of why we were at the meeting, we were saying that maybe the market got it a little bit ahead of itself, and maybe we wouldn't quite have as many cuts that were getting cut that were being priced in. But they didn't really do that, and in fact, they kind of went out of their way to kind of say, "Hey, we're still on track for cuts despite these hot inflation prints." And so, listen, here's the thing: is you can't ignore those type of comments. Now, it doesn't mean you have to rush out and get max along just because they said them. But they are trying to kind of guard markets, and listen, maybe they will cut into an inflationary tailwind and a booming market. And if the market continues to hold up, we've talked about this many times, John. Higher rates are kind of a tailwind for markets until you hit the wall of the refinancing, and the higher rates makes it harder to borrow. But until you hit that wall, it's kind of a tailwind. So if you have a tailwind of higher rates, and you have a tailwind of the Fed going to be cutting rates in an environment where unemployment is low and corporate profits are doing okay, that's kind of a good environment to be long equities. And so I think that's why equities are continuing to do what they do. Now, I don't want anybody to think that, I'm changing my tune and now it's time to get long at the all-time high. That's not my point. My base case is still that we're going to have a correction, but it's probably a correction that you buy as opposed to a correction that you sell into. But I can't rule out the fact that maybe they will cut. And here's the thing: is based on the design of the system, Fed, central banks, government authorities, monetary, they want inflation. They have to have a certain level of inflation in order for the system to work. That's why they always say we have a policy goal of 2% over time. The reason it's not zero is they need inflation for the system to work. And they also need inflation to kind of inflate away the debt. Now, if they could get 3 or 4% inflation for 10 years, that eats up 30 to 40% of the debt. And they would love to have that. Now, they can't come out and say that openly. And they can't have 8, 9, 10, 12% inflation because that's politically unacceptable. But if they could get 3 or 4% inflation for, dozen years, that's pretty good for a central banker. I think they would take that because it allows them to perpetuate the system. So, with that in mind, for them to cut into an environment where inflation is still high, it's not totally out of the question. So then the question becomes, well, if they're cutting rates, is that bad for the dollar? Well, it could be bad for the dollar in the very short term, especially if the rest of the world has not started cutting. But I would argue that we're not going to be in an environment where the U.S. is cutting dramatically and the rest of the world is not. And the reason is the rest of the world is doing worse than the U.S. is right now. And, Europe is largely in a recession. Japan is headed into a recession. China is largely in a recession. Again, I don't know what the official numbers say, but, their real estate market and their stock market and their currency tell you that China's in a recession. And so the idea that these other countries are going to have a stronger monetary policy than the United States, I just don't think holds up. So you could get into a situation where everybody's easing, but the U.S. is easing the least. And so on a relative basis, it still has tight monetary supply or tight monetary policy on a relative basis. And I think that's kind of the milkshake, John, right? And that, I think if that were to happen, if they were to goose markets higher by cutting rates when inflation is still high, I think that would actually pull more capital into the United States. And again, then you start depriving other countries of capital, then they have to cut even more, and it becomes this vicious loop. So it kind of goes back to your point last week when you said, Brent, is the milkshake already kind of happening and we just don't know it? Listen, again, my base case is that we're going to get a correction because I think we need one. And I think that's what provides the juice to then send us higher. But if they decide to just cut into high inflation, then maybe we don't need the recession. So what I'm trying to give you is an understanding of how things could continue to go higher. Because I think there's a lot of people out there who think markets just cannot continue to go higher. And I'm here to tell you, they can go higher. Now, again, I'm not changing my tune. I'm not saying to go out and change everything you're doing. I think we're going to get a correction, but I'm not so arrogant as to believe that we cannot possibly continue higher. And I'm trying to give you an idea of how that could possibly happen.
Well, I think, let's just say 3 months ago, maybe it was the second Fed pause. You start thinking at that point or projecting forward when a rate cut might come. we hadn't seen any kind of correction in asset prices at that point. And obviously, we still haven't. They've rocketed higher. But at that point, you could start to make, maybe we'll call it a fundamental argument, that the Fed would cut rates because you have declining inflation. The Fed doesn't really want real rates. They don't want their policy rate above the inflation rate. So they're cutting in line so that monetary policy isn't unnecessarily tight and choking things out when they're trying to navigate this soft landing. So I think that makes sense 3 months ago. You fast forward to now, and the big sevens, now the big six, then the big four. And it just feels like you have a handful of equities, mainly in the tech sector, that are the milkshake, at least in terms of the equity market. They're sucking in all the capital. Things are rocketing higher. Home prices, mainly driven by, I think, a supply phenomenon, aren't going lower or regulating themselves. They keep kind of inching higher. So asset prices aren't adjusting. And you're making this point as far as the Fed cutting rates, and inflation is something that they want. I think we understand, it's written in their policy they want 2%. I think the higher they can get without blowing things up or getting pitchforks and torches coming at them, they would like, because it would erode the debt. The problem I see with that, and potentially why they might cut at this moment, despite things still running hot in certain sectors, is the credit market. So banks are in trouble. Commercial real estate been a conversation for 18 months and is now starting to really show its weaknesses. But also the U.S. government blew it, right? Yellen blew it. She didn't refinance, and issue 10-year, 20-year, 30-year bonds when interest rates were 1%. So if the government's funding itself on short duration T-bills and the Fed's shooting for 4% inflation and rates are high, yes, it erodes some of the debt, but then the government has to refinance themselves at higher rates. So do you think, short term, we haven't talked about this at all, but given some of those points I presented, is extending something like the bank term funding program an option to at least stabilize the banking sector? How do you think these two phenomenons of the Fed wanting inflation and being somewhat okay with asset prices running hot, while at the same time the credit market's kind of falling apart?
Well, again, I think the Fed is a reactionary agency. I don't think that they're necessarily true. I think if and when they need to do something to save either the banks or the CRV and or commercial real estate or whatever, either housing or whatever it is, then I think they will act at that time. I don't think that they're going to be proactive and get in front of that, especially when inflation, at least from a political standpoint, is still too high. From a political standpoint, I think that it's still an issue for the administration going into the election, which again is why I kind of don't think that the Fed is going to cut aggressively into the election, because I think that would be politically tough to do. But again, I cannot rule it out. And so I think, I think we just kind of got to play it as listen, this is a really tough environment. If you are not already long equities, or if you have just been sitting in cash, this is an incredibly tough market from a relative perspective. Now, if you're an individual and you're just sitting in cash and you're making 4% on your money market or 5% on your T-bills, that's honestly, I don't think that's bad at all. Just sit in cash and be patient, because you're actually getting paid to wait right now. But if you're in this industry that I'm in and you are managing money and you've just been sitting on the sidelines and markets just continue to go higher, you have career risk. Especially if you're benchmarked to some index or if you're benchmarked to your peers. And it's a really tough environment. I mean, it's really tough to just be on the sidelines when every day the market goes higher. And if you're short, then it's death, right? And so, listen, there will be a hard correction at some point. I don't know when it's going to be. I think we're going to get it sometime in the next few months, but we might not. And so I think you have to be aware of that. And those are some of the factors of why it hasn't happened yet, because it's really hard to be short in this market. I mean, but because it's so hard to be short, everything is skewed the other way. Call buying is through the roof. Put buying is really low. Sentiment is really high. The VIX is really low. So you have the setup for when it turns, it can turn really hard and really fast, but we just don't know when it's going to turn.
One of the things we've talked about a ton here is the violently sideways nature of markets, where, at the end of the year, we did a video called The Great Reset. It was kind of tongue in cheek because you had shown that over the last 2 years, we basically went full circle. All the hype and excitement really just got us back to the starting line. Now, looking at the setup, and as we're getting closer and closer to the point where, like, how much higher can this go without a correction? Do you see the violently sideways pattern changing?
I think we are going to see a change in the violently sideways. I don't think that we're going to go sideways for the next 2 or 3 months. I think we're either going to go down hard or we're going to go up hard. I don't think we're. Can I be wrong? Of course I can be wrong. Maybe we'll be exactly right here in 3 months, but I don't think so. I think we've got to a point where it needs to move one way or the other. But what I find kind of interesting is I was looking at silver and the miners this week because they've just come off so hard, and I was remembering back to the first week of December when the miners were running higher and silver was running higher, and I had these guys on Twitter telling me, "See, Brent, you missed it. You're so dumb." It was so obvious that the Fed was going to pivot, and miners were going to take off, and silver was going to go to the moon. How could you be so stupid? Basically, this is the basic conversation. And then I looked looking at last week, and now silver's back down to almost $20, and the miners were back down to and then over the last couple of days, even with the hot print, silver has started to bounce a little bit. And I was cracking up because I was just waiting for them to come out and say, "See, silver's bouncing. Here it comes again." Because they always say that. And so I think we're going to have over the next couple of months. I think we're going to see a big move in some asset prices, whether it's gold or oil or equities or bonds.
It's always worth reminding people, being that you're now become the dollar guy, the dollar milkshake guy, that your Twitter handle is Santiago AU Fund. So at the core, you're a precious metals bug. But again, it's understanding the system, how the system works, and the timeline for this to play out. It's not that you're not bullish gold, silver, and everything else. It's just understand that that's going to be a very violent journey to the top before there's some sort of battle between the dollar and gold.
Well, yeah, I mean, it's pretty funny because you had two hot inflation prints this week, and yet the dollar rallied and gold fell, right? So, everybody will often say they buy, inflation, or they buy gold for inflation purposes. Well, why is the dollar going higher, and why is gold going down when inflation comes in hot? And it has to. If that isn't evidence enough that you kind of need to think through some things, and you can't just repeat the jargon that you've memorized, I don't know what else to tell you.
Now, do you think a big part of that is just you can get paid to wait in T-bills, and if there's hot inflation, the Fed's not going to cut, so you're still getting a decent yield, while gold is more of a an appreciation play or crisis play.
Yeah, and this is the thing and I know there's so many people out there saying, yeah, but you're not making 4 or 5% in real terms, and it's getting inflated away, and gold doesn't have a counterparty. And listen, that's all absolutely correct. But if you really want to understand markets, you'd almost be better if you couldn't think for yourself and you had to. I'm saying this the wrong way. The way to figure out what's going to happen in markets is you have to think like other people, because it doesn't really matter what you would do, especially if you're a gold guy. You have to think like a fixed income manager or an equity manager who is a Keynesian who learned of the classical way and has never even heard of gold, because those are going to be the big moves. And that is largely why, gold and silver, I think the people who have focused there have gotten it wrong, because they don't have the ability to think outside their own framework. And I think to understand markets, you have to understand your own framework. Somebody sent a thing I saw on Twitter today, and I retweeted it. And I think it was Ray Dalio who said it. And I'm not a huge fan of Ray Dalio's, but I love this quote. He said, "Don't get caught up in the way you think things should be, because in the process you'll miss the way that they actually are." And I think that's a perfect way to think about it. The market is going to go the direction that the herd takes, not the direction that the contrarian takes. So if you're going to be the contrarian, things are going to go against you for a while. And then when the herd finally figures out that you're right, then it will go your way. But if you want to know what's going to happen when a news release comes out or when a headline comes out, you have to stop thinking like yourself, and you have to think like, what's the herd thinking? How is the herd going to interpret that?
Gotcha. So look, we say all the time that whether you like the data, trust the data, or think it's complete garbage, it doesn't matter because markets trade on it. Markets trade on expectations. And when the expectation is either not met or is blown out of the water, you need to be prepared to play along with markets and what the herd does in those moments. Brent, we know you got to go. I can see the sun setting. You're going to have some champagne and some lovey-dovey. So we'll let you enjoy that. But before we go, I have it on my notes here to ask you this, and it's a complete, curveball out of left field, but kind of funny.
Oh, Lord.
What do you think about nat gas? I mean, this thing has just been every once in a while you get the urge to play nat gas, and it's like the new Widowmaker.
Yeah. I don't know, man. It is so tempting. I've been watching it very closely. It is so tempting to go and put a trade on. But it is the Widowmaker. This is the thing. I'm glad you brought this up because this is a perfect example of something to say that you just never know what's going to happen. And I'm saying this to all those who are so certain that they think that either Bitcoin's going to work or gold's going to work or equities are going to work or whatever your trade du jour is, that you are just so certain is going to work. Think back to 18 months ago or almost 2 years ago, or a little over 2 years ago when Putin invaded, Ukraine. And the absolute obvious trade was to go long energy and short U.S. equities because we were going to have, high inflation and energy was going to go through the moon and we are going to have a massive recession. But look and see what happened. Equities are now higher. And yeah, nat gas spiked from, $3 to $10. And now it's at like $1.60. Now, think about how certain you were and everybody else was that energy was the play, right? And yet it's been the exact wrong play. And now you've got, nat gas at like 15-year lows or something. So it just goes, you just never know what's going to happen. And you have to have the ability to kind of protect yourself or get out or have some kind of a hedge. If you have a really strong conviction, that's fine, but you have to have some kind of a way to protect against being wrong because the most obvious trade in the world is not always correct.
Well, we'll end it on that note. We appreciate it, Brent. Enjoy the rest of your Super Bowl week with another great weekend. Best of luck to you tonight and the next 20 years with you and Mrs. J. And we'll talk to you hopefully maybe perhaps midweek if things get crazy. Otherwise, we'll see you next weekend. Everybody, we appreciate you joining us. Find us on Twitter, YouTube, all the places. We've had our avatars and handles up on the screen so you know where to get us. We'll talk to you real soon. Brent, any last words for our Milkshakes fam?
No, just have a great weekend. Oh, you'll get a kick out of this. We were at a restaurant and there's a couple sitting next to us. And I said, wow, that looks like Dylan Brooks. My wife said, who's Dylan Brooks? I said, oh, he's an NBA player. And I looked again, I was like, that is Dylan Brooks. And she's like, wait, the NBA's going on. What's he doing in here? And I said, well, he's good enough to get an NBA paycheck, but he's not good enough to be an NBA All-Star. So it's the NBA All-Star weekend. So I guess this is where NBA players go when they're not good enough to go to the All-Star game.
Well, you challenged the All-Stars in the dollar debate, came away a winner, in my opinion. Maybe you can challenge him to some one-on-one if you see him again. Otherwise, stay safe. Have a great evening and happy anniversary to you. We'll see everyone real soon. This show is provided for entertainment and informational purposes only. It should not be relied upon as legal, business, investment, or tax advice. Neither the hosts, guests, nor any funds they may manage intends to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies.